When tech companies announce massive layoffs, they often blame artificial intelligence. But is software actually doing the work, or is something else draining their cash? By the end, you will be able to explain the exact balance sheet pressure forcing executives to trade human salaries for expensive silicon. Tech layoffs are all over the news, but the popular explanation is wrong. Software isn't suddenly smart enough to replace white-collar workers. The real driver is a massive, structural reallocation of corporate cash. Look at Meta platforms. To build tomorrow's tech, they aren't just buying ready-made software. They are pouring astronomical sums into building it themselves, shifting priorities from daily operations to long-term research. In 2022, Meta became the world's third-largest spender on research and development. Their annual R&D bill totaled an incredible $35.3 billion, showing just how expensive this transition really is. To fund these massive tech bets, executives have to make a hard choice. They are trading operational payroll, the people running today's services, directly for long-term capital expenditure. It is a pattern we have seen since they started as the Facebook in 2004. They rebranded to Meta Platforms in 2021, targeting the metaverse, and are now shifting billions more into AI. But these massive development budgets require a reliable, gargantuan source of revenue. If tech giants are spending tens of billions on development, how do they actually generate the cash to sustain this level of investment? To fund a $35 billion annual research budget, a company needs a massive, reliable engine. For Meta, that engine is not hardware, subscriptions, or licensing fees. It is the attention of billions of users. Meta operates a massive advertising network spanning its own platforms and third parties. Every scroll, click, and interaction feeds a targeting system designed to sell user attention to the highest corporate bidder. This network is not just a side business. In 2023, advertising accounted for 97.8% of Meta's total revenue, making it the single pipeline keeping the entire corporate structure alive. When almost all your money comes from one source, any sudden market shift becomes an existential threat. A drop in advertiser spending or a change in privacy tracking rules can instantly starve the company of cash. To protect itself, the leadership must react instantly to broader economic trends, forcing sudden and massive strategic pivots. When executives decide to change direction, thousands of workers are caught in the wake of their course corrections. This brings us to a critical turning point. What happens when a company decides to pivot its entire brand identity away from this reliable ad revenue machine? In 2021, the company rebranded from Facebook Incorporated to Meta Platforms Incorporated. This reflected a massive strategic shift toward developing the metaverse, an interconnected digital ecosystem of virtual and augmented reality. This was no fringe player trying to find a niche. By 2023, Meta was ranked 31st on the Forbes Global 2000 list of the world's largest public companies. Yet, building this new digital ecosystem required an immense reallocation of capital. Instead of just writing code, they had to spend heavily on physical infrastructure, server farms, and specialized hardware. To put a number on it, by 2022, Meta became the world's third-largest spender on research and development, with R&D expenses totaling an astronomical $35.3 billion. Silicon, concrete, and energy are incredibly expensive. When massive budgets are redirected toward physical assets, the financial pressure immediately transfers to the company's operating expenses and payroll. While megacorporations can absorb these infrastructure costs, how does this capital crunch affect other highly technical creative sectors? Before the market shifted in 2022, gaming looked entirely bulletproof. Microsoft was expanding aggressively, managing a massive ecosystem that spanned physical Xbox hardware, complex digital operations, and dozens of acquired game development studios. But in 2022, the wider video game industry suddenly stalled. As pandemic restrictions lifted, consumer habits shifted quickly, and people spent less time and money in front of their consoles and computers. At the exact same time, the cost of developing blockbuster titles was spiraling out of control. Studios were spending hundreds of millions of dollars on single projects, banking on a pandemic-era growth rate that no longer existed. When the revenue flatlined, executive teams panicked to protect their profit margins. Instead of scaling back their ambitious tech investments, developers began quietly cutting the actual people who built the games. This sector serves as a leading indicator, because game development requires both high-end software engineering and creative artistry. These early cracks signaled a structural restructuring that would soon sweep through the entire tech landscape. The massive hiring spree of the previous decade had left thousands of highly skilled workers exposed. When these costs spiraled out of control, how severe did the resulting labor cuts actually get? Between 2022 and July 2025, the video game industry became the focal point of this restructuring, shedding an estimated 45,000 jobs as the post-pandemic boom evaporated. The true scale of this sudden contraction was laid bare in the 2026 State of the Game Industry report, published by the Game Developers Conference after surveying over 2,300 professionals. The findings were stark. 33% of surveyed American game workers had been laid off during the prior 2 years, outstripping the 28% global average. These job cuts did not hit everyone equally, occurring twice as often at massive AAA studios, where 2/3 of respondents reported layoffs compared to independent ones. The collapse forced over 30 development studios to close their doors entirely, with regional hubs like California absorbing half of all layoffs across North America and Europe. Beyond the sheer volume of lost jobs, what did this sudden flood of talent do to the wages of the workers who remained? The sudden influx of unemployed developers flooded the hiring market, particularly in California. From 2023 onward, California alone absorbed 50% of all the gaming industry layoffs across North America and Europe. This hyperconcentration of jobless talent created a brutal buyer's market. By 2025, desperate competition for the few remaining open roles caused salaries for specialized positions, like Unity programmers, to collapse by an estimated 50%. Programmers who previously commanded premium compensation packages suddenly found themselves competing against hundreds of equally qualified peers, forcing them to accept entry-level rates just to secure a stable paycheck. The pain wasn't limited to individual payrolls. It systematically erased entire creative hubs. Over 30 video game development studios shut down completely during this wave, liquidating years of institutional knowledge. Highly respected teams like Arcane Austin, Sanzura Games, Volition, and Sony's London studio were completely dismantled, their developers discarded into an already oversaturated, highly competitive labor pool. If these severe layoffs are driven by structural capital demands, where did this intense pressure to satisfy public markets originate? That pressure took shape on January 1st, 2012, when Facebook filed for its initial public offering. The young company, then commanding 845 million monthly active users, prepared to transition from a private playground to a public giant. Wall Street underwriters set the price at $38 a share, targeting a massive $104 billion valuation. It was the largest valuation ever attempted for a newly public tech company at that time. The offering successfully raised $16 billion, making it the third largest in U.S. history. But the initial excitement quickly evaporated once the actual trading began on the public exchange. By May 25, 2012, the stock ended its first full week of trading at $31.91. That was a sudden 16.5% decline from the initial offering price, catching investors off guard. This early stumble taught tech executives a harsh, lasting lesson. Public markets are brutal, and they penalize any company that fails to prove it can maintain strict cost discipline alongside growth. Which leads straight to the present day. How do modern tech executives use the narrative of artificial intelligence to satisfy these same demanding public markets today? They do it by framing mass layoffs as an inevitable transition to an automated future, rather than what they actually are, a direct cash transfer. Tech companies are not firing people because algorithms can do their work today. They're firing people because building those algorithms is incredibly expensive. In 2022, Meta alone spent $35.3 billion on research and development, a massive capital expenditure that requires immediate cash. To fund these giant infrastructure budgets without alarming Wall Street, executives must trim their biggest recurring cost, which is human payroll. We saw this in the gaming sector, where 45,000 workers lost their jobs. The remaining talent then faces a flooded labor market. By 2025, Unity programmers saw their salaries plunge by an estimated 50% as companies realized they could squeeze more work out of fewer, cheaper people. By blaming artificial intelligence for the job cuts, executives spin a tale of technological progress to satisfy shareholders who demand high profit margins, hiding the truth that they are simply swapping salaries for server racks. You are left realizing that artificial intelligence is not replacing your job because of its competence, but because its development costs are consuming the very budgets that used to pay human salaries.